Welcome to the daily update, where I'll go over the action in the market for Wednesday, September 4th, and then we'll see how things look for Thursday, September 5th. Had a slight down day, but it goes in the books as a negative day, so it's making some of our indicators switch over and look more negative. Also helping out with some of the extreme positive readings that we've been seeing lately. The main thing that I'm focusing on right now is especially the 50-day moving average, but right at that same level is the 20-period moving average. And as long as we can stay above that, support is holding. Now, we are looking a little more negative and the market is looking a little more vulnerable. But until we actually break below and close below the 20 and 50-period moving averages, we still have more of a positive stance with things. Please know I do have a thing called the SPXInvesting Program. It's free for right now, so feel free to check that out. You get immediate access to the daily and weekly videos. If you want to learn more about that, there's a link that'll take you to the website as well as to a video that you can learn more about the program. There's also an email address if you have any questions and you want to ask me about that. The daily videos, the real foundation of the analysis that I do, with all the weekly videos supplementing into the daily video. All right, let's go back and talk about what happened. We did have a lower open. Europe was a bit weaker. The futures were coming down, but we were off of the lows. We were anywhere from about 1/4% to 0.5% lower as we were getting closer to the open, but that did lead to a lower open. But then we saw this buy the dip come in, and we were able to get back above the unchanged level, but we hit resistance at the daily pivot at 55.52. That also set the high for the day. As the day went on, we went back down to the unchanged level, and then we chopped above and below the unchanged level for a while. We did find support at the 20 and 50 period moving averages there, and we were able to bounce up a little bit and close off of those levels. So we were down 0.16% on below average volume, and we're still hanging on tentatively to being positive in the short, intermediate, and long term. We're watching those moving averages. We're watching the deterioration of some of our indicators. If we have another down day and there seems to be some conviction behind it, that is going to switch us over to a more negative environment. Oil is now continuing to drop, even with the geopolitical things going on. That's really why we're watching it currently, but we're actually dropping below the 70 level. And the VIX is going up, where we were above 20 after Tuesday. We continue to be up, and now we're over 21 after Wednesday's session. The 20 and 50 period simple moving averages are still providing support for right now. And that's a pretty critical thing. And the mass index, we've been watching this. This got triggered actually a couple of weeks ago, and it was triggered as we were going up. Is this actually a legitimate signal? I don't use this independently. I don't use it all by itself, but we're seeing some confirmation in some other charts. But it's the 20 and 50 period moving averages that at least I'm focusing on for right now. And then we are still extreme when we look at our slope oscillator, but we're down below the moving average now. So it's extreme positive, but it's declining. And our stochastics is actually on both lists here. We have it on the overbought and oversold list at the same time. So we also showed that the Stoch RSI, Williams percent R, and CCI 14. This is just showing that, yeah, we're going down. I mean, there's really no surprise there. But to see the stochastics on both overbought and oversold at the same time is kind of interesting. And we are still looking extreme with the TTM squeeze, but it's coming down. The PMO studies are coming down, but we still have one study that's extreme. And the 10-period moving average of the highs and lows for the S&P, it's also declining, but still extreme. Long-term, declining with the 200 and 150 simple moving averages, but still looking extreme there as well. No change to the scenario. We'll see if the employment data coming out this week actually has an impact on what's going to happen with the Fed. If that report comes in weak, everyone's going to be screaming recession and rate cuts, and it's going to be similar to what happened at the beginning of August. So, yeah. And the dollar was down after it had been bouncing up for a few days, and interest rates continue to fall. We're at 3.77 with the 10-year yield, where after Tuesday we were at 3.84. We're just barely inverted with the 10 to the 2-year. We have a ways to go with the 10 to the 3-month, but we're still inverted with these. And sentiment came all the way from positive. And we had really kind of a crazy reading after Tuesday. A big decline and sentiment goes up. Kind of strange there. We drifted down now to neutral, where we're coming in at 53. And we're still not trending. The ADX is declining. It's below 20. It's below its moving average. And so that means we're in a non-trending environment. The red line is on top, so we default to negative there. With the down day, slight down day, the bias is negative, and I'm still keeping the momentum at mixed to negative for right now. I'm watching those 20 and 50 period simple moving averages. If we close below that, then we're going to be switched over to a negative stance there. All right, so we had the weekly MBA mortgage applications index down 1.6%. Last week it was up 0.5%. The trade balance came in weaker than expected at 78.8 billion. Last time it was at 78.5 billion, and also greater than the 73 billion we saw last time. Factory orders were up 5%. They expected them to be up 4.5%. Last time they were down 3.3%. This is one of the employment pieces of data that we're starting to get this week. Job openings are decreasing at 7.673 million, down from the 7.91 million that we had in the last reading. So here's the chart, and we don't look at this to make decisions about the market. This is just kind of almost like a sentiment gauge here. Folks are feeling more positive about things, and I know it can take a while to get a mortgage. But typically, in a more positive environment, we see more people getting mortgages and more refinancing going on. And that did come up over the last couple of weeks. And looking at the trade balance here, it is going down and getting more negative. And we look at imports versus exports, where we're seeing an increase in the imports, that's yellow, and a decrease here in the exports. And here's also showing the deficit actually getting more than it had been before, more negative. And here are the job openings, still positive, still a lot of jobs out there, but really starting to come down. We're seeing a trend here, and we'll see if that lines up with some of the other employment data that we'll be receiving. And we are coming off of being extreme positive here with the overbought, oversold composite. Looking at the Isabel Net blog charts here, this is probably going to continue to come down if we see more weakness. And then looking in purple, this is the S&P, and looking at the ISM manufacturing, this did turn up. But the takeaway, if you look over on the left-hand side, we're below 50. So this is still showing contraction in the manufacturing part of the economy. And this kind of makes common sense, I guess. The largest stocks, they contribute to most of the volatility. And when we're going down, volatility goes up. Since we're dealing with the S&P 500, which is a weighted index, yeah, that's going to have more of an impact. And the M2 money supply, after we saw it really going up during the whole COVID lockdowns and everything, it had been drifting lower. Now it's starting to go back up. This could be somewhat inflationary. And the market pricing of Fed policy against the Bank of America, this dark blue line, this is what the market thinks will happen. And then we have this lighter blue Bank of America forecast here, and then this is the Fed projection. My goodness. So this is just the takeaway from this. Yeah, they get different points of what they think are going to happen. But I would take away the fact that these are declining. All right, and then we are seeing a little bit of an outflow now when we're looking at the fund flows. And these are high quality, high grade, like more conservative corporate bonds and government bonds. But they've been really the place to be, at least recently. Now we're seeing the 12-week moving average rolling over just a bit. And then other central banks around the world are already cutting rates. The Fed has yet to do so. This just shows what's happening globally. And this is kind of interesting. 1929 versus 2024. Is it going to play out the same way? Don't know. But this is kind of interesting, something to be aware of. Things got pretty good there in earlier part of 1929 and then got really bad. So that's why we do the daily analysis here, because things can change quickly. That's why in the strategies that I teach, I always see, in fact, personally, I always do hedging, because you don't know. Something weird can happen at any given time and things can switch quickly. And if you're not really paying attention, what had been gains can then suddenly turn into losses. And then we have old Brett here that posted looking at, okay, what happened other times when the Fed started to cut rates. Of course, he has a lot of things going down. Initially, we might see a bit of an upsurge and then a decline after that. We're comparing it to 1981, 1990, 2000, and 2007. Just wondering if something like that is going to play out this time. And sentiment trader, and this is one reason why we watch the growth of value and do a lot of studies between them. The correlation on a 6-month basis is getting very, very low, and that quite often can be negative. And you can see other times where we still went up for a while, but then after that, it led to some pretty significant declines. And then showing a real move into the leveraged and inverse ETFs. And it's easy to get caught up in this. You go, oh, wow, 3 times ETF, 2 times ETF. Yeah, look at all this money you can make, without realizing that it's a two-edged sword, that when you're wrong and things go against you, you're losing 2 or 3 times faster in that way. But that hasn't taken away from the popularity, because people have this idea that they want to make a lot of money quickly, and so they feel they can do it this way. Now, I don't use these personally. I use the SPY because the options are a lot more liquid and I can hedge those a lot easier. There are options on these, but they're not quite as liquid. We don't get as good of bid ask. The spread can be kind of wide, the open interest and the volume. It can be a little hard to set up some hedging on these types of positions. But there's members in the program that do use these and are really taken by them, and they like to use them. Another thing that I don't do with either the leveraged or inverse ETFs is I put indicators on them, but I don't base my technical analysis on what I'm seeing in those charts, because they're supposed to be in either 2 times or 3 times relationship. It doesn't always work out that way. And so it can get a little out of whack with the index itself. Even the SPY can get a little out of whack at times. And so I look at those charts with indicators on them, but I don't base decisions on that. I use it more for confirmation, or, okay, we're seeing it here on the regular SPY, but we're not seeing it here on one of the leveraged or inverse ETFs. All right, here is our intraday chart showing the big down move that we saw on Tuesday. We did have a lower open on Wednesday. We were able to get back up to the daily pivot, but that was the high. And then we came back down, kind of camped around the unchanged level. We broke down here, and this is about the 20 or 50 period moving average right here. That was the low that was set on Tuesday. So far, this support level is holding after Wednesday, and we bounced up a little bit off of that. Here's the intraday chart, not showing a big change in the initial overnight session. Currently, this is a concern that we've been watching, where the blue line is underneath the red line here. That's growth is underperforming value intraday. And this is also another concern. Starting about August 20th, 21st or so, we've been seeing the growth to value ratio intraday really continuing to decline for the SPY. And that's putting some pressure on stocks with the SPY anyway to actually go higher. Here's our end of day, where growth was down more than value. It was down less for the mid caps and a little bit more for the small caps. So we're still really going down here. Small cap growth to value ratio, mid cap growth to value ratio, S&P growth to value ratio. Yeah, a little bit of a tick here, but we didn't see a really big change in Wednesday's session. We're also getting a little concerned here. The growth to value between these ETFs falling even more below the rainbow. And after we had been coming back up, when we look at discretionary versus staples, now it's starting to fall back down and showing more weakness here. But we're still holding up when we look at large cap growth. We're still above the 100 period moving average. We've dropped below the 50 on this one, but this is more somewhat longer intermediate term to even a little bit longer term with the 100 period moving average. And here is our trend and the condition of the trend. We were not able to break out of this sideways pattern that we were in for a number of days. Now we're potentially breaking to the downside here. Or we have already broke, but is it going to continue? That's what we're trying to figure out. And the ADX is declining. It's below its moving average. It's below 20. So this is a weakening non-trend currently. And the red line, even though it declined a little bit, is still above the green line. So we default to negative. Also, seeing pretty much that same thing in the short term, but an even deeper non-trending environment on a short-term basis. And we're picking up with volume, but we were below average in Wednesday's session. And starting to climb back up here with the VIX, both with the line chart and the bar chart. And when that goes up, the VIX goes up. We see the VIX of the VIX also going up as far as the bar is concerned. It was a little bit higher, but on a closing basis, it actually came down since we didn't have that big of a change in the daily session. But now the momentum of the VIX is switching back over as measured by the MACD, and the momentum is now going up for the VIX. And this is the seasonal chart, just to see if we're going to end up following what has happened there. And look, keeping an eye on the volatility of bonds, where volatility is going up, volatility of stocks are going up, and we're seeing a pretty high correlation between the two here. And this is not measuring direction. In a way it is, because when especially with stocks, when volatility picks up, that means stocks are going down, where volatility is picking up with bonds, but they've actually been hanging in there pretty well. And we're also watching the skew index, which is a variation on the VIX. It continues to go up. So the market for the last number of sessions has been anticipating some kind of a big move. And we saw that big move on Tuesday, not much of a move on Wednesday, but the expectations of that move just continue to increase right now. And we declined with this fear gauge, where we're continuing to go back up with this other fear gauge. So a bit of contradiction there. We were ticking down just a little bit with the daily equity put call ratio, but we're still going up with the 5-day and the 10-day. And we're declining here with our risk on to risk off ratio. This is showing more risk off. Folks are getting out of the riskier stocks according to this ratio. And we ticked up just a little bit, barely changed here, where the large caps were just a little bit better than small caps. And we're seeing a pickup here with the volatility risk premium. It had been giving us very low readings for much of August. Now it's starting to come back up into this band, as we're seeing that confirmed by the VIX going up as well. But we're coming down, but still looking positive here with the advanced decline line based on price, also declining based on volume. We have been watching this. We broke out with price. We didn't really break out with volume, but we're still above an advancing moving average. So this is hanging in there, but we're concerned that volume has been lagging. And still looking okay here. We dropped down with the new highs. We're starting to roll over with the 5-day, but we're still going up with the 10-day. But this is another internal measure just showing that, yeah, there's a lot more new highs, a little bit more new lows, but the new highs are really outnumbering the new lows. And declining, but still positive with our advanced decline ratios. So when we look at the 19-day, after being extreme positive, we're coming down. We're also going down a little bit more here based on volume. Both are still positive since they're above zero, but they are declining. And accumulation distribution starting to come back down to the moving average now. If it crosses below, that will turn this smart money indicator negative. Declining a little bit here with the histogram, but still going up with the red line with this other smart money indicator. But we're continuing to decline here with the Chaikin oscillator. However, we're still above zero. And we're coming down. We're positive with the vortex, but the green line's screaming to the downside. The red line's really been coming up. So this is another concern that we're having right now. And we ticked down a little bit here with the S&P advanced decline line on a cumulative basis. For price, it ticked down. And we ticked down a little bit more here based on volume. And we look at the new highs minus the new lows, still looking positive after getting quite extreme here. This is just a daily score. And then I have a red 50-period moving average on top of this. Well, to make that a little easier to see, I break that out down below. This is continuing to go up, and this is still positive. And here's our 10-day average of the highs and lows for the S&P, coming down, but still giving us an extreme positive reading. And here's another look at the new highs, new lows. This is color coded a little bit differently, where we continue to go up with this chart. And we compare the S&P with the NYSE advanced decline line. Both have been under pressure lately, but the NYSE advanced decline line is holding up a little bit better, at least according to this measure. And we look at the cumulative NYSE advanced decline line based on price. We declined, but we're still above the moving average. Also showing a decline here with our regular advanced decline line, but still above an advancing moving average. Also a decline with this other NYSE advanced decline line, but above an advancing moving average. And the common stock coming down based on price and volume. But our advanced decline line studies continue to be holding up fairly well, even though they are declining. They're all above their moving averages. So coming down to the 50-day moving average now on the daily chart, and we dropped below average with volume. We're coming down with the 20, 50, and 200 period moving averages on the S&P. We're extreme negative now with the Stochk RSI, the Williams percent R, and the CCI 14, where the CCI 20 is just a little bit above the midpoint. It moves a little bit slower. The condition of the 20 period moving average, we're dropping below the lines. The lines are starting to roll over here, but we're still hanging out at the 20 period simple moving average. That's the red line here. We're just closing right on it. And there's all of the different moving averages. And then I have a breakout of the 50 period later, where if we can hold on to this and then bounce back up from here, that would turn things more positive. If we break down below this, that's going to turn things more negative. And the stochastics in the short term were extreme negative. We're still extreme positive in the long term, and we're just declining, but still positive in the intermediate term. We're still negative with the force index. We're dropping below the midpoint here with the standard deviations chart after getting a really high reading with those stocks in the S&P above their 20 period moving averages starting to come down now. That was something I was focused on over the weekend, and that seems to be playing out right now. And our study is also showing some weakness, but still, it could bounce back up from here, but it's coming off of that extreme reading. We declined with the 50 period moving average study, the 100, and also the 200. Intermediate term, declining slightly, but the balance of power is still positive. We're dropping below the condition of our 50 period moving averages here, and that is potentially turning these lines over, which could turn things more negative. But when we look at the breakout chart of the 50 period moving averages, we're still right at the simple moving average based on 50 periods. So we have the 20s and the 50s still with support that is holding. And turning a little bit more negative now with the go, no go, with the lighter blue bar, dropping below the midpoint with the highest high, lowest low value chart. And we're declining here with the TTM squeeze. We're still above this black line, giving us an extreme positive reading, but now it is coming down. And this is a longer term look at that same chart, just to give you some perspective of other times when it looked like we were topping out. And the ease of movement is declining, but still positive. The Arun is just flat, not really showing us much there. Declining, but still positive with the S&P McClellan oscillator. So we're going up based on price, but we're declining based on volume. So this is another negative divergence that we're seeing that is causing some concern. We're negative with the NYSE McClellan oscillator since we dropped below zero. So it's really hard to see, but we're just starting to roll over now with the summation index based on price and volume. Swenlin trading oscillator, declining but above zero based on price, declining and below zero based on volume. So we're seeing another negative divergence here. And momentum is showing some weakness now. We're rolling over with the PMO, rolling over based on price and volume. And we're declining with the PMOs that are rising. The buy signals are declining, and we're just barely extreme positive with the PMOs above zero. And we're continue to be negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're extreme positive with the slope oscillator by itself, but we're below the moving average now and declining. So that's actually more negative. And the MACD is starting to cross below its moving average. So we're seeing some weakness now in the short and intermediate term with our oscillators, rolling over now a little bit with the longer term oscillators. The Copic curve has now turned negative, and the Sean trend meter has declined enough to go back to neutral. And the bullish percent index holding up fairly well, but it is declining. So we want to keep an eye on that one. And we're declining, but still above 50 with the NYSE bullish percent index. And we're declining and in danger of going below 50 with the NASDAQ 100 bullish percent index. We are still positive, but if we drop below 50, that will turn this negative. The money flow is declining, but still above 50. We've turned negative now with the ultimate oscillator. The RSI dropping below 50 based on 14 and 9 periods, switching the momentum back more to negative. Declining, but still above the moving average with on-balance volume. And now we're ticking back up just a little bit as we've been declining. This is that mass index. And when we hit this and started to come back down, that is suggesting that there will be a reversal in the market. And we won't really know if that's playing out that way or not. We just kind of have to watch this and use it use other charts to confirm this or deny this. And we're still getting, so for some reason, a Pring bottom fisher buy signal. All right, so we're coming back into the 20-period moving averages here. And right now, this is a support level that continues to hold. We're also coming back into the Ichimoku cloud here. This is another support level. And longer term, we are declining, but we're above this R2 support level on the SPX weekly chart. And coming down and dealing with this 50% fib extension level for the SPY. And we're turning more negative with the Heiken Ashi. We're negative with the Kegi chart. We're still positive with the Renko chart and turning more negative with the 3-line break chart. And showing a bit of a decline, just barely coming off being extreme positive with the 150 and still slightly more extreme positive with the 200. And we're negative in the short term with all the different indexes that we follow. We're negative with stocks in the short term. We're positive with bonds based on price, but we're negative across the board with commodities and the dollar. And we saw utilities, staples up the most. Discretionary was up just a little bit, but energy just got hammered and communication got hammered. And then tech ended up being down slightly again. These are more the growth areas that we focus on. And we saw a lot of negative things right off the bat, but then the Dow was able to get back above 41,000. And then the real estate, which has been showing a lot of improvement. It set a new 2-year high with its ETF. And we look at the S&P with the equal weight, and both have been coming down lately, but the equal weight is holding up for the time being. And we're declining just a little bit here with the ratio, just showing that the equal weight did slightly better than the S&P in Wednesday's session. Here's a daily chart of the NYSE, just showing even though we have been going down, we're still seeing a positive answer when we look at new highs minus new lows, and declining, but still above this pivot point with the Dow after setting a new all-time high last week. The diamonds continue to be neutral, and we're dropping below the pivot point with the NASDAQ here, dropping below the pivot point with the NASDAQ 100. That's a little bit of a concern there. We continue to be negative with the Qs when looking at the Elders Impulse system. Momentum for the NASDAQ 100 has now turned negative. And we're below all the 20 and 50 period moving averages here. And that's more technical damage for the QQQs. And dropping a little bit further, even though we had a slight up day below this 23.6% fib extension level for the Qs. The small caps, they were down 0.21%, dropping below this pivot point, but still above their 50-day moving average. We're right down at the 50-day moving average when we look at the Russell 2000 small caps, but we're below 50 with the RSI. The momentum is rolling over and starting to turn negative. And we're negative with the small caps when looking at the Elders Impulse system. And we're still going up here. Even though small caps are under pressure a bit, they're doing better the last few sessions when you compare it to tech. Mid caps also declining down to its 50-day moving average. It's negative with the Elders Impulse system for the mid caps. And still looking positive here. We take the Amex, NASDAQ, and NYSE and do a 5-period moving average of the highs minus the lows. That's dropping down, but it's still positive. The Wilshire coming down to its 50-day moving average. This might be another thing to watch to see if we're able to hold on to that support level. Also coming down with the total U.S. stock ETF down to its 50-day moving average, another broad market support area that we want to keep an eye on. The staples to tech ratio is really going up, and that's negative when we're looking at staples outperforming the tech sector. The FANG index already below its 50-day moving average, still in a longer-term uptrend, but showing some weakness currently. And right about on this trend line, going back here earlier in 2023, connecting this longer-term trend line, this support level's holding right now. If we start to drop below that, we're going to get more concerned about the market. Financial sector still doing well, not up much, but breaking out and looking pretty positive. And when we compare financials to the S&P, the ratio is really going up, and we're about ready to see a golden cross with this ratio. Apple was down 0.86%, still dealing with its 50-day moving average. Amazon still dealing with its 200-day moving average. Microsoft at its 200-day moving average. Meta coming close, but still above its 50-day moving average. Google dealing with its 200-day moving average. NVIDIA breaking below its 50-day. There's an antitrust threat out there that may be happening with NVIDIA, and that's putting some pressure on the stock right now. And Tesla was up over 4%, coming back up to its 50-day moving average. Netflix was up 0.65%, still above its 50-day moving average. And looking at US stocks compared to world stocks, really seeing a deterioration of the short-term correlation. The longer-term correlation is still holding up. Oil is now dropping below 70. We're watching this for geopolitical reasons. It'll really spike up if things escalate even more in the Middle East. Utilities continue to go up for right now, which can be taken as a defensive measure. And the staple sector, another defensive measure, continues to go up right now. And this is what will happen often before the market gets ready to decline. The dollar did decline here a little bit, and we are seeing a recent death cross here showing a downtrend for the dollar after it had been bouncing back up the last few sessions. Here's a look at this where we broke above the trend line, came down below it. Now we're coming back down and dropping below that trend line again. And here's bonds. We continue to fall with the 10-year yield. We continue to go up with the 10-year based on price. Here is the 10 to the 2 yield curve at 0.01, minus 0.01 here. If we can close above this, this would be the first time in over a couple of years that the yield curve is no longer inverted. And we're looking, we want to keep an eye on this. This is 1 to 3 month T-bills, which is cash compared to 3 to 7 year bonds. When this is going down, that tends to be more positive for stocks, but we want to know the context. Are we starting to be concerned about what could happen in the economy? And we're not really going to know that to any more conclusion until the employment situation comes out on Friday. And seeing a little bit of threat here to the soft landing scenario that the market has been anticipating. We're coming back down into the rainbow. And also, this is an inverse of that same thing, showing how bonds have been starting to outperform stocks. They're still underperforming longer term, but with this spiking up, that's a little bit of a concern to us. And the Qs to 3 to 7 year bonds coming back down into the rainbow, showing some weakness right now. We're not really seeing any improvement here with Qs to S&P declining. We're seeing a bit of a tick up here with discretionary to the S&P, but we're declining when we look at large cap growth versus large cap value. So we're declining with the large caps, mid caps, and small caps. Not what we want to see in a positive environment. The S&P to utilities ratio continues to decline. We want that to go up to be more positive for the S&P. And the staples to S&P ratio really going up. That's negative for the S&P. We want this to go down, and that would be more positive. So what's our outlook for Thursday? We're positive, and I'm basing that around the 20 and 50 period moving averages. But we're seeing more weakness develop with some of our other indicators. But for right now, support is holding. We're going to get the weekly jobless claims and continuing claims, the ADP employment change, productivity and unit labor costs, the ISM non-manufacturing, which are services. These are some pretty influential reports. And then we want to keep an eye on what's happening geopolitically in case that impacts the market. And then on Friday, we're going to get the employment situation report. And here is the highlight of what will be coming out on Thursday and then what's coming out on Friday. Okay. Do they have? All right. Then looking at seasonality here, no real edge, slight positive edge here when we look at September 5th. And then Thursday, it's done fairly well to how we compare it with 2023. And it's the most positive day when how things have performed in 2024. And then this is a newer chart showing the month of September put out by Carson. The first part of September tends to hold up fairly well. It's the latter part, when we get into about the 19th or so, that's when things tend to see more seasonal weakness. And we're also trying to say, okay, here's all the election years and how the market did on an average basis. But then when there's an open field, we tend to see more weakness going forward. And September tends to be weak, followed by October, according to this chart. We're also negative in September, according to this chart, but positive in October. And then we take August through October, and we tend, over that 3-month span, tend to be negative overall. And then we compare 2024 with 2023, wondering if we're going to see things start to decline as we did into the latter part of October, like we did in 2023. Comparing non-election years with presidential election years, where we often see some weakness. Let me find September here. where even no matter what year, whether an election's happening or not, we do tend to see some weakness going into October. And then going back to 1950 with the election years, the S&P, you can roll the dice here on as far up year or down year. 9 out of 18 times up, 9 out of 18 times down, but the return is minus 0.4%. So our warning signs, keeping an eye on these defensive sectors that we've been watching. The equity put call ratios are going up. That's negative. The McClellan Oscillator and Summation Index for the NYSE, that is turning more negative. The parabolic SAR, our oscillators are turning negative, not in the long term, but more in the short and intermediate term. The momentum for the NASDAQ 100 has now turned negative. The ultimate oscillator, the Copic curve, and we're not seeing any real help from growth to value. We're seeing a little bit of an improvement with discretionary to staples, but we want to see more of that continuing. And then the positive side, we are declining with our smart money indicators, but they're still positive for the most part here. And the advanced decline line is holding up for right now. The S&P, based on price, when we look at the McClellan Oscillator and Summation Index, that's positive, but the volume is declining. So that's a negative divergence. And the Swenlin Trading Oscillator, we're positive based on price, negative based on volume, another negative divergence. And the bullish percent indexes, we're close to getting negative with the NASDAQ 100, but we're still positive with the S&P and NYSE. Ease of movement is still looking okay, even though it's declining. The money flow declining, but positive. The vortex declining, but still positive here. The financial sector is actually looking quite strong in and of itself. So our conclusion, we're still positive based on the 20 and 50 period moving averages. We are turning more negative, but for right now, support is holding. And that's what we're seeing in the short term and in the intermediate term. In the long term, we're still looking positive there, coming down with the 150 moving average, but not with the 200. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.